Hello, this is Will Allen with Sentara Capital. In today's market update, we are going to cover a new milestone that the federal government just hit here that involves the $1 trillion number. We also are going to talk about the fact that over the last 15 years, there has been an incredible disparity between economic growth here in the U.S. and most economies around the world. And we're going to look at what has been the investment implication of that disparity. Let's dive in. Before we get into the market update, just a reminder to like and subscribe so you can make sure you never miss one of our videos. Thank you very much. Okay, the milestone that I talked about earlier was that the federal government is going to be paying out over $1 trillion in interest. And this is something that we're talking about today because the Wall Street Journal just had an article on this topic, and it was titled, "A $1 trillion Conundrum, the U.S. Government's Mounting Debt Bill." Now, look, it's important to note that for many years, there has been concerns about how much government has been spending under both Republican and Democrats alike. Both have been spending a lot of money, but now that the government is going to spend over $1 trillion this year on interest, this is going to have an impact in a number of ways. So we want to put a chart up that shows, as you can see here, that this year there's going to be $1 trillion spent on interest. This means that the only two categories that the government is going to be spending more on than interest is Medicare and Social Security. And so obviously this is a lot of money. The government just 3 or 4 years ago was spending around 500 billion in interest, which is still a lot. But now that it's up to over $1 trillion, that is 500 or 600 billion dollars that they could have done other things with or not spent at all, and that would be less that Americans would be spending in taxes, but that is now going to interest. So this is something that we're just paying a close attention to because it's now, when you get to $1 trillion numbers, that gets the market's attention. You may remember back in the summer, in early August, we did a video where we talked about the fact that the Treasury Department on July 31st had said that they were going to be issuing over $1 trillion of Treasury bonds in the third quarter. That really rattled the markets. It led to a decline in the stock market and in the bond market. Interest rates shot up. That sent the mortgage rates from 6.8% all the way to 8.1%. So for those of you who are looking to get a mortgage or were looking to buy a house back in the October-November timeframe, that had a real impact on things. So that was then. Since then, the markets have rallied back under hopes that spending will come down a little bit. We'll see if that takes place or not. We're a little bit skeptical, but we at least wanted you to hear from us what had happened here with the Treasury Department's issuance of over $1 trillion back in the summer, and now the government having to spend over $1 trillion on interest. That is not a positive thing. The next point that we wanted to make comes down to this. Back about 15 years ago, a lot of the large Wall Street firms decided that they were going to recommend to their advisors to make international investments a large part of client portfolios at the time. And the idea was that, hey, there's a lot of very strong economic growth taking place around the world, and so companies in those parts of the world should do very well, and so we need to invest in that area. Well, we wanted to take a look back here because now it's been about 15 years since that started to take place. And let's put a chart up that compares the economic growth, GDP growth in the U.S. versus some of the other countries internationally. All right, so the first slide that we're going to put up here is US GDP, and you also see on this screen there will be Japan, France, Germany, and Italy. And so from left to right is the US GDP and these other countries as well, with their growth over these last 15 years. And you can see if you look on the right side, the US is up at the top in purple. Our economy has grown at 83% going back since 2010. You have to drop down and you'll notice that Germany is number 2 with a 32% growth rate over that time frame. Japan is number 3 at 18%. France is number 4 at 15%, and Italy is number 5 at just at 3%. That is a massive, massive discrepancy there. The U.S. has had a much higher growth rate, and I'll tell you one of the reasons for this is that a lot of the technology sector here in the U.S. has flourished. Whereas in a lot of these other countries, there's a lot more regulations and stipulations and whatnot. It's a lot tougher. And so the technology sector there just hasn't done as well. But it's not just technology here in the U.S. There's a lot of other companies and sectors that have done really well powering growth in the United States. And I'll also mention tax policy has had a lot to do with it as well. Our tax rate is much lower than in many of these other countries, and that does have an impact. Now, we're going to look at what has international investments done relative to the U.S. because there isn't always a 100% correlation between a country's growth rate in a given year from their economy and how their stock market does. But over long time stretches, there is a high correlation. So we're going to put up a chart now that shows the growth rate or the returns of the U.S. And you can see here the U.S. is the S&P 500 over this same time frame. It is in orange here. And you can see 495% return in the S&P 500 since early 2010. That is a really strong return for the stock market here. Then if you go and you look at Europe, for example, the European stock market is up 124% in that same time. Not terrible, but if you think about over 15 years, that's not a great annual return. And then emerging markets up 36%. Emerging markets is 1/3 China, and then you have India, Brazil, Russia, countries like that make up the rest of it. And the reason I put emerging markets in there is that in 2010, there was a huge campaign, so to speak, from some of the big Wall Street firms that said, listen, over the next 10, 15 years, China is going to be the place to invest because their economy is growing at a great clip and they have 1.4 billion people. This is going to be the next frontier. Well, the fact is President Xi, for the first few years, China's stock market did well. But over the last 5 to 6 years, it has done very poorly as President Xi has kind of walked back some of the more free market principles that they had started to implement. He's undid almost all of those, has gone after their large companies, and that has been a big problem for the stock market. China's stock market today is in the same spot that it was in 2007. And so emerging market investors have done very poorly over the last 15 years. As you can see, only up about 36%, with the S&P 500 up almost 500%. We here at Sentara Capital have said for the last 10 plus years that we do not count on international stocks and emerging market stocks as core parts of client portfolios. We have a very small allocation to international stocks at the highest level over the last few years, and right now we don't have any allocation to international stocks. Now, that said, I do want to say one thing, which is when we invest here in the U.S. and in a lot of the big U.S. companies that are in the funds we're at, or for example, in some of the individual stocks we're on, a lot of these companies sell to individuals or companies overseas. And some of the companies here in the US get more than 50% of their revenue and profits from international markets. So we do have some exposure in that way, but as you can see, looking at those returns, anyone who had 20, 30, 40% of their portfolios in international and emerging markets these last 15 years, and by the way, there are a lot of people in those kind of portfolios at the large Wall Street firms, that has majorly damaged their returns over the years versus being here in the U.S. Well, that is it for this market update. Don't forget, as a reminder, to like and subscribe, and we will be back in 2 weeks with another update where we are going to recap fourth quarter earnings reports, and that's very important, to also talk about company guidance. What are companies seeing for 2024? We also will recap the most recent inflation reports. A lot of important information that we have gleaned in the last week there. So take care, have a good one, and we'll talk to you soon. Well, thank you very much for watching our video. If you are new to Sentara Capital, you have not seen our videos before, you can go to our website, sentaracapital.com, and go to the contact page. You can reach out and call us, 770-509-5305. And this way, you can schedule an appointment with an advisor, and if you aren't hearing from your advisor, you're not getting market updates, give us a call. We'd love to talk to you. Thank you very much.